Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The Reserve Bank Board has delivered another jumbo rate hike, increasing the official cash rate by 50 basis points at its July meeting yesterday. For a homeowner with a $500,000 mortgage, that's about $130 extra a month in repayments. It comes after a 50 basis point jump last month and 25 basis points in May. So is this going to be enough to bring inflation under control? Diana Mousina is the Senior Economist at AMP. Diana, welcome back to Fear and Greed.
Thank you so much for having me on.
So 50 basis points was widely expected. Clearly, the Reserve Bank's pretty serious about getting a handle on inflation.
The RBA is trying to be aggressive in front-loading these rate hikes because they are concerned that inflation expectations could get out of control, they'll get entrenched at a high level, and that will be harder for the Reserve Bank to bring them down if they get too high ultimately. And I suppose also the RBA is watching the inflation story play out in the US and I guess arguably in Europe as well. And they're thinking we don't want to get to the same situation that these countries are in terms of inflation printing at 8 or 9% on a headline annual basis. I mean, we think that inflation will peak at about 7%. So we're not really too far away from what's happening globally.
Okay, so what the bank said yesterday, it talked about anchoring inflation expectations, and we've spoken about this on Fear and Greed previously, just how important expectations of inflation are. Why is that the case?
Because it determines the trajectory for price rises and for wages growth. When consumers and businesses expect and price into expectations and forecasts for wages, for how much they're going to increase prices by, if you continue to get on this spiral, I guess, of continuing rises in prices, you can get to a situation where you get inflation printing at extremely high levels, well over 5% on an annual basis for a prolonged period of time. And that destroys purchasing power for everyone in the economy because it becomes unsustainable. And that's what we don't want to see. I don't think that we're likely to get there, though. I do think that we are getting a little bit carried away about how high inflation can get. I mean, yes, it is high at the moment, but we have very strange things going on that are unlikely to persist forever. So I don't think that we should be worried that we are going to get a wage price spiral. And the central banks are clearly being so aggressive with rate rises that they're going to get this under control.
I mean, some of those strange things you're talking about, things like Ukraine war and energy prices, supply chain problems because of COVID, that type of thing?
That's right. And also in Australia, we've had the flooding across the east coast of Australia. And now in the last week, we've had more bad weather, which will put even more upwards pressure on fresh food, fruit and vegetable, meat, seafood prices. But that's unlikely to continue forever. It may be another few painful months for consumers in terms of high prices for fresh food. But it's unlikely that that will be the same situation in 2023. We've seen these periods before where we see big price rises for some fresh food in Australia because of weather events and the like. The problem at the moment is that we have high prices for food, but also at the same time high prices for petrol because of what's going on to the oil price. Ukraine is a key input into that, but also other factors, and also just the general rise in commodity prices. So we're seeing an across-the-board increase in a lot of different prices that consumers pay for every single day.
Stay with me, Diana. We'll be back in a minute. I'm speaking to AMP Senior Economist Diana Mousina. How do you think the fact that we've had sort of 30 basis points, 50 basis points, another 50 basis points, as you said, front loading in consumers' psyche? I mean, I know how much more I'm paying on my mortgage when my bank puts up the mortgage rate that I pay. It's actually a lot of money.
It's a huge increase. You were talking about the figures earlier, Sean, about how much an average household would be down on a mortgage of $500,000. And we're talking about a significant increase in monthly costs that consumers have to take from somewhere. Yes, they could take it from accumulated savings that we've spoken about before that they've built up, or prepayments that they've done. But if you're taking money out of savings, then later down the track, are you not going to be going on that holiday because you've already taken the money out of savings to pay for your mortgage? There's a lot of flow-on effects, and it will take some time for that to show up in the data. but it will start to show up and consumer spending will slow. I mean, I guess that's also the purpose of why the RBA is raising rates. They want to see consumer spending slow down, because part of the reason for why we have high inflation is because the economy is too hot and has been running at a very heated level for the last year, and they want to slow down the pace of economic growth. But it will start to show up in the data, and I think it already is starting.
The bank's statement yesterday did actually focus a bit on household spending and what would happen whether they draw down all the savings they've had in the bank. But clearly the bank wants to keep an eye on what households are doing.
Well, this will be the health check of the economy. Consumer spending is 60% of our GDP. So if you see a significant deceleration in consumer spending, that will have huge ramifications for economic growth, and then also obviously the flow-on effect to business investment and business spending. There's also this effect called the wealth effect, which happens when home prices decline or when consumers feel less wealthy. They tend to reduce their spending and increase savings. And interest rate rises impact the housing market quite significantly. So when we see these interest rate rises go through into the housing market, we think home prices will be down 15 to 20% peak to trough into 2023, and that will have further negative downward effects for consumers.
Yeah, the other thing that the bank said yesterday, the Reserve Bank said yesterday, was it's not just about inflation, it's also about getting monetary policy settings back to more normal levels. How much further do they need to go to get to more normal levels?
Well, our guess is that a more normal level of the cash rate would be somewhere at around 2.5%. At that kind of level, we think that there will be enough downwards pressure on inflation to get it back to a more comfortable 2 to 3% target band, probably at the top end of that target band, but then, an expectation that it would get into the RBA's range. I think cash rate any further above 2.5% would put significant downward pressure on consumers that would result in a economic downturn and potentially the risk of a recession. Market is still pricing in a very high cash rate, close to 4% in a year's time. I don't think that is sustainable in Australia based on household leverage. Our housing sector, our leverage that consumers have to housing is very different compared to countries that we compare ourselves with at the moment, the US or Europe. US consumers are not as leveraged. They're not as impacted by changes in interest rates because of the way that their housing structures are done in terms of the fixed and variable rates. So I don't think consumers would be able to handle a cash rate above 2.5% unless the RBA wants to engineer a recession to get inflation down. But I don't think that they will need to go that far. I think inflation will naturally fall over the next 6 to 12 months.
So is the forecast that the cash rate, which is now 1.35%, will get to 2.5%. Is that likely this year, do you think?
We see the cash rate ending this year at about 2.1% and then in the middle of next year to peak at about 2.5%. So some further rate rises next year, but a much slower rate rise cycle. The risk is that the RBA wants to do all the rate rises this year, so maybe we'll see a cash rate close to 2.5% by the end of this year. And of course, I think the overall risk is that we're still too dovish of our own expectations for the RBA and that they'll want to increase rates further to get that downward impact on inflation. So the risk is that the cash rate peaks at a higher rate than 2.5%.
The meetings inside the Reserve Bank seem to have changed a lot in the last 6 months. Like it's a very different outlook from the bank than it was 6 months ago.
Well, the RBA didn't forecast the rise in inflation very well, and they've said that themselves. So I guess that they've had to change the way that they're going about looking at the economy and the process. So they've changed their minds based on the current situation in Australia and also globally. And I think that was the right thing to do, obviously.
Yeah. Okay. And then just finally, the Reserve Bank said that any future moves in monetary policy would depend on data, though obviously it's made it clear that interest rates are still rising. What are the key data points coming up in the next month, 2, 3 months or so that we should all keep an eye on, which will influence what the Reserve Bank does?
Well, in Australia, we get the consumer price data quarterly. So we get our next print in late July. That will be a key factor that will determine what the size of the rate rise is in August. We favour a 50 basis point move, but it could be higher. It could be 75 basis points, because I think that the risk is that CPI comes out stronger than what the RBA has been forecasting, given what's going on with inflation around the world. And then, of course, we need to watch the labour market data closely to see how businesses are responding to a rising interest rate environment. And then on a more monthly basis, I like watching the consumer sentiment numbers, which also come out weekly, to see how consumers are feeling about higher interest rates. And also our own AMP trackers that we've put together, which is a timely indicator based on weekly bank credit card data, retail spending, foot traffic, these types of high frequency indicators that we're watching during COVID to track how consumers were changing their behavior before, during, and after lockdowns. But I think that that's quite becoming relevant again, because we can see how consumers are changing their behavior based on the current interest rate environment and also the high inflation environment.
And you can see through that data that people are already changing their behaviour?
There's been some early signs of it. Some of the bank data is starting to soften a little bit over June, but it's been a very slow start for consumers to show any signs of weakening. I think that it will still take some months for it to show up in the data. And consumers, they don't necessarily respond straight away to rises in interest rates. But there's a lot of different things hitting consumers at the same time: higher interest rates, higher petrol prices, higher prices for fresh food. And that should eventually show up in softer retail data.
Diana, thank you for talking to Fear and Greed.
Thank you so much.
That was AMP Senior Economist Diana Mousina. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.